For much of the last decade, Texas stood as the crown jewel of America's housing boom, a symbol of endless growth, migration, and prosperity. Cities like Austin, Dallas, and Houston became magnets for new residents fleeing high-cost states such as California and New York. Builders scrambled to keep up, fueled by cheap borrowing and a flood of pandemic-era demand. Between 2020 and 2022, homes were flying off the market within days, often sparking bidding wars that pushed prices to record highs. For many, the Texas dream felt unstoppable. But by 2025, that dream began to crack, revealing a very different reality. The same factors that had propelled Texas's rapid rise have now turned against it. As the Federal Reserve began tightening monetary policy, mortgage rates shot upward, rising from historic lows below 3% to nearly 7% by early 2025. This spike in borrowing costs hit affordability like a hammer. Buyers who could once stretch for $400,000 homes suddenly found themselves capped at $300,000 or less. The result? A sharp, almost immediate cooling in buyer demand across the state. According to the Texas Real Estate Research Center, total home sales fell during the first quarter of 2025 despite record levels of inventory, a sign that the market had shifted decisively from feverish demand to cautious hesitation. At the same time, the flood of new construction that defined the pandemic boom began working against the market. Texas led the nation in new home permits in 2024, accounting for roughly 15% of all new builds in the country. Developers, optimistic after years of sky-high sales, kept building even as demand softened. When combined with a wave of homeowners who finally decided to cash in before prices fell further, this surge of new listings created a massive oversupply problem. By April 2025, active listings had ballooned to 123,000, more than triple the pandemic low and 53% higher than pre-2020 averages. For years, migration had been the backbone of Texas's housing boom, drawing hundreds of thousands of people with its promise of affordability, space, and lower taxes. But by 2024, that engine had sputtered. Net domestic migration fell by 62% compared to its 2022 peak, dropping from over 220,000 to just 85,000 new residents. Fewer transplants meant fewer high-income buyers entering the market, which left local buyers, already strained by inflation and rising rates, struggling to fill the gap. What emerged was a perfect storm: high supply, low demand, and unaffordability all colliding at once. Homes that once sold in days now lingered for months. Price reductions became the norm rather than the exception, and sellers faced the grim reality that Texas's unstoppable housing market was no longer defying gravity. The boom had officially ended, not with a crash, but with a long, grinding correction that's forcing everyone, from builders to investors to homeowners, to adjust to a new and sobering normal. The clearest and most undeniable signal that Texas's housing market has entered a full correction is the explosion in available inventory. After years of scarcity where buyers fought tooth and nail for every listing, the state now faces the exact opposite problem. There are simply too many homes for sale and not enough people willing or able to buy them. This shift has transformed the market's psychology almost overnight. What was once a seller's paradise has rapidly become a battleground where price cuts and longer listing times dominate the conversation. The data tells the story with startling clarity. According to Reventure App and the Texas Real Estate Research Center, active listings across the state reached 123,237 in April 2025, the highest level seen in well over a decade. For context, pre-pandemic inventory levels from 2017 through 2020 averaged around 80,000 listings statewide. During the pandemic boom, that number plunged to a mere 35,000 in 2021, creating intense scarcity that sent prices soaring. But by 2023, the tide had started turning, with listings climbing to nearly 69,000. By 2024, they hit roughly 95,000, and within just a year, that figure ballooned another 30%, marking a historic jump that few analysts anticipated happening so quickly. This surge in inventory isn't just about homeowners suddenly deciding to sell. It's a complex mix of oversupply and falling demand. Builders, having ramped up production aggressively during the boom years, now find themselves with excess units as sales slow. At the same time, existing homeowners, many of whom delayed selling during the pandemic, have re-entered the market, trying to capture what value remains before further price declines occur. The result is a flood of listings from both new and resale homes hitting the market simultaneously. In fact, Texas now ranks as the fourth most oversupplied housing market in the United States, according to Reventure's analysis. Adding to the imbalance is the fact that entry-level homes, once the lifeblood of the Texas market, are leading this inventory explosion. Data from the Texas Housing Insight Report shows that homes priced under $300,000 have experienced year-over-year inventory growth of nearly 39% since early 2024, far outpacing higher-end properties. For many of these lower-priced listings, affordability remains out of reach due to elevated mortgage rates, keeping first-time buyers on the sidelines. With fewer qualified buyers and a growing pool of available properties, even competitively priced homes are struggling to attract offers. For sellers, this new reality is painful. Properties that once received multiple bids within days are now sitting for months, forcing price reductions and renewed marketing efforts. In some regions, particularly around Dallas-Fort Worth and Central Texas, listings have tripled compared to pandemic lows. The dynamic has flipped completely, power has shifted from sellers to buyers. In short, skyrocketing inventory marks the definitive turning point for the Texas housing market. It signals not just a cooling trend, but a structural shift toward normalization after years of unsustainable growth. The market that once thrived on scarcity now faces an excess that's rewriting every rule of Texas real estate. If the surging inventory represents the visible symptom of Texas's housing correction, then the affordability crisis is the underlying cause. For decades, affordability was Texas's greatest selling point, the reason families, retirees, and remote workers flocked to the Lone Star State in search of space and stability. But by 2025, that narrative has flipped entirely. Homes once hailed as cheap by national standards now cost far more to finance, and buyers who could once easily qualify for a mortgage are being priced out by high interest rates and rising monthly payments. The numbers are stark. Mortgage rates have hovered between 6.75% and 7% through the first half of 2025, nearly triple the levels seen during the pandemic boom. The Texas Housing Insight Report notes that this rate spike has pushed the typical mortgage and tax payment to 32.5% of a household's gross income, far above the long-term national average of around 23%. That means the same home that might have cost $1,800 a month in 2021 can now cost over $2,800, even if the sticker price hasn't changed. For most Texans, whose wages haven't kept pace with inflation, that jump has proven insurmountable. This affordability squeeze has had a chilling effect on buyer demand. Total home sales across the state declined in the first quarter of 2025, despite record inventory levels. In February alone, just over 21,800 homes were sold statewide, a 6.2% drop compared to the same period last year. Many potential buyers have simply stepped back, choosing to rent or wait for conditions to improve. Even those with stable incomes are reluctant to buy, fearing that home values could fall further in the months ahead, a self-reinforcing cycle that weakens demand even more. The hardest hit group has been first-time and moderate-income buyers. Entry-level homes, which once represented a gateway to ownership, now sit unsold as financing becomes harder to secure. The Texas Housing Insight Report highlights that the sharpest rise in inventory occurred in this segment, with listings for homes under $300,000 growing more than 30% year-over-year. These buyers often depend on low down payments and mortgage qualification flexibility, both of which have been eroded by higher rates. As a result, the very demographic that once sustained Texas's growth has been sidelined. For the average buyer, this affordability crunch isn't just a matter of waiting for lower prices, it's a matter of math. Even with modest price drops, the higher interest burden wipes out most savings. A $350,000 home at 7% interest costs roughly the same monthly as a $450,000 home did at 3%. Until borrowing costs ease significantly, meaningful affordability relief is unlikely. This shift has reshaped the psychology of the market. Gone are the bidding wars and rushed offers, in their place is hesitation, negotiation, and caution. Buyers now hold more leverage, but many can't afford to use it. The Texas dream of easy homeownership has collided head-on with economic reality, and for now, it's the affordability crunch that's keeping the market frozen in retreat. The Texas housing market's most pressing challenge in 2025 isn't just that prices are falling, it's that there are simply too many homes and not enough qualified buyers. The state's extraordinary construction pace during the pandemic years, once seen as a symbol of economic vitality, has now become its biggest vulnerability. What began as an effort to meet unprecedented demand has turned into a full-fledged oversupply problem, pushing the market into correction territory faster than many expected. During the pandemic boom, Texas builders couldn't lay foundations fast enough. Fueled by low interest rates and massive inbound migration, developers flooded the market with new housing projects, confident that every home built would find a buyer. By 2024, Texas accounted for 15% of all new home permits issued in the United States, leading the nation in construction activity. Cities like Dallas, Houston, and Austin became construction hotspots, with cranes dominating skylines and suburban communities expanding outward at record speed. But when demand began cooling in late 2023, and migration sharply slowed, the momentum didn't stop. Builders continued producing at a pre-boom pace, even as the buyer pool shrank. By early 2025, the imbalance became impossible to ignore. The state had 123,000 active listings, a 53% increase above pre-pandemic averages and more than triple the lows seen during 2021 to 2022. According to Reventure app data, Texas is now the fourth most oversupplied housing market in the entire country, trailing only a few select Sunbelt states facing similar corrections. The implications are serious. Excess inventory means sellers must compete harder, often resorting to deep price cuts just to get noticed. This oversupply isn't evenly distributed. The Texas Housing Insight report reveals that entry-level homes are driving much of the glut, with listings in the sub-$300,000 category surging nearly 39% year-over-year. These were once the state's most in-demand properties, the very homes that fueled the promise of affordable living. But with mortgage rates near 7%, even these budget homes are out of reach for many working-class Texans. Meanwhile, in mid-tier and high-end segments, inventory has also risen steadily, though not as explosively. Homes priced between $300,000 and $500,000 have climbed 30% in available listings, while those above $750,000 have grown roughly 25%. The oversupply has turned local markets upside down. In Dallas and Austin, homes linger longer on the market, often double or triple their previous average selling times. Builders, burdened with unsold inventory, are offering incentives, rate buydowns, and even free upgrades to lure hesitant buyers. The same neighborhoods that saw bidding wars 2 years ago now face open houses with no attendees. This flood of supply is creating a classic economic imbalance. When there's too much product and too little demand, prices must fall until equilibrium is restored. The Texas market is now in the thick of that adjustment. Analysts warn that if oversupply persists into 2026, particularly with slower job growth or another energy sector downturn, the market could experience deeper price declines before stabilizing. For a state once defined by limitless expansion, the current reality serves as a sobering reminder: even Texas can build too much, too fast. The heart of Texas's housing crisis lies not in its luxury neighborhoods or commercial skyscrapers, but in the segment that once defined its promise: entry-level homes. For years, Texas was the beacon of affordability in the United States, offering first-time buyers and middle-income families a realistic path to homeownership. But as of 2025, that foundation has cracked wide open. The very homes that symbolized opportunity have become the epicenter of the market's oversupply problem, and the data tells a story of imbalance, frustration, and fading optimism. According to the Texas Real Estate Research Center's March 2025 Housing Insight, entry-level properties, typically those priced below $300,000, have seen the fastest acceleration in inventory growth across all price tiers, climbing at an average of 39% year-over-year since spring 2024. These homes now account for roughly one-third of all active listings statewide, a dramatic increase from the pandemic era when such properties were nearly impossible to find. Back then, low interest rates and migration-driven demand created intense competition, forcing many Texans to bid above asking just to secure a deal. Fast forward to 2025, and the script has completely flipped. Listings under $300,000 are piling up, and buyers are nowhere to be found. The reason is clear: affordability has collapsed. Mortgage rates hovering near 7% have drastically reduced what the average household can afford. For buyers who depend heavily on financing, as most entry-level purchasers do, every percentage point in interest eats away at purchasing power. Even with prices softening, monthly payments remain unmanageable for many. A $275,000 home, once an easy target for young families, now carries a monthly payment similar to what a $350,000 home would have cost during the 3% interest rate era. This has sidelined thousands of potential buyers, leaving a massive chunk of the market in limbo. Sellers in this price category are facing growing pressure. Many of these are not developers, but individual homeowners or small investors who bought during the pandemic at peak prices. Now, as homes sit unsold for months, they're forced to slash asking prices just to attract attention. In fact, over 70% of sales statewide in early 2025 involved price cuts, with the average reduction hovering around $12,500. Yet even these cuts aren't enough to reignite demand, as buyers remain constrained by financing costs and economic uncertainty. The effects ripple beyond the first-time buyer market. Entry-level homes play a crucial role in housing mobility. When they don't sell, move-up buyers can't progress to larger homes, freezing the entire real estate ladder. Builders, too, are feeling the strain. Many pivoted to entry-level construction during the pandemic, assuming demand would remain endless. Now they're holding excess inventory, offering incentives and temporary rate buydowns just to move units off their books. In essence, the entry-level segment, once the lifeblood of Texas real estate, has become a cautionary tale. The flood of unsold homes in this category isn't just a market statistic, it's a reflection of a deeper affordability crisis reshaping the state's economic landscape. Until borrowing costs fall or incomes rise substantially, these homes will continue to sit, a visible reminder that Texas's housing boom has shifted from prosperity to paralysis. When prices start to fall, it's often the final confirmation that a market correction has truly taken hold, and across Texas, that moment has arrived. What began as a steady rise in listings and slowing sales has now evolved into a wave of price cuts sweeping through nearly every major metropolitan area. From Austin to Houston, sellers are lowering their expectations and slashing asking prices at rates unseen since the aftermath of the Great Financial Crisis. The days of bidding wars and over-asking offers have been replaced by a new reality: discounts, negotiation, and a race to the bottom. According to the Texas Real Estate Research Center's March 2025 Housing Insight, more than 70% of closed home sales in the first quarter of 2025 involved price reductions of at least $5,000, a figure that surpasses even the 2011 downturn levels. Sellers have become increasingly aggressive with their markdowns, as homes sit longer on the market amid weakening demand. The median price cut in March reached $12,500, up from $10,000 just a year earlier, representing roughly 3.6% of the listing price. While that might sound modest, it marks a significant psychological shift in a market where just 2 years ago, homes routinely sold above asking price within days of listing. These price reductions are not confined to one city or price tier, they're statewide and widespread. In Dallas, the rapid growth in inventory has created intense competition among sellers, forcing many to drop prices multiple times within a single listing cycle. Austin, once the hottest housing market in America, has seen some of the steepest corrections. Home values in the metro area have fallen over 20% from their pandemic peaks, and analysts at ReventureApp note that prices are likely to decline further in 2025 as listings continue to rise. Even San Antonio and Houston, which held up better initially, are now showing cracks, with more sellers opting for upfront discounts rather than waiting months for offers that may never come. What's driving this wave of price cuts is a perfect storm of factors: higher mortgage rates, buyer hesitancy, and oversupply. The affordability crisis has severely shrunk the pool of active buyers, meaning sellers must compete fiercely for attention. Many homeowners who bought during the 2020 to 2022 surge now find themselves locked in, unable to sell without accepting a loss. Builders are also contributing to the downward pressure, offering generous incentives such as temporary interest rate buydowns, free upgrades, or closing cost assistance, all of which effectively function as price cuts under a different name. In smaller Texas cities, the pain is even more pronounced. Markets like Pecos, Zapata, and Sweetwater are projected to see price drops ranging from 6% to nearly 10% by the end of 2025. These local declines highlight the unevenness of the correction, a reminder that while some regions may stabilize sooner, others could still be in for deeper losses. The broader takeaway is clear: the pricing power has completely shifted. Buyers now hold the upper hand, negotiating harder and demanding more concessions. For sellers, the message is sobering: list realistically, or risk watching your home linger as values slide further. Texas's housing market has entered its most humbling phase yet, one defined not by record highs, but by widespread reductions as the state fights to find its new equilibrium. While Texas as a whole is experiencing a widespread correction, not every city or region is suffering equally. The state's housing market has become deeply fragmented, a patchwork of winners and losers shaped by local economies, migration patterns, and job growth. The once universal boom that lifted every metro area together has fractured into regional disparities. Some markets are holding their ground or cooling gradually, while others are plunging headfirst into decline. Understanding this divide reveals how complex and uneven Texas's real estate landscape has become in 2025. At the top of the list of markets under pressure is Austin, the poster child of both Texas's meteoric rise and its current fall. During the pandemic, Austin's home prices skyrocketed by more than 60%, driven by tech migration, remote work, and investors seeking high returns. But that rapid climb has set the stage for an equally sharp descent. According to ReventureApp, Austin's home values have dropped more than 20% from their pandemic peak, making it one of the hardest-hit metropolitan areas in the country. Listings in Travis County and surrounding suburbs have surged by double digits, up 12% in Travis, 16% in Williamson, and a staggering 24% in Hays County. Analysts now expect prices to fall an additional 0.4% by October 2025, solidifying Austin's transition from a red-hot seller's market to a buyer's playground. Dallas-Fort Worth is facing its own reckoning. Once buoyed by corporate relocations and a robust job market, DFW is now struggling under the weight of excessive inventory. Builders overshot demand, and the influx of listings has cooled prices substantially. According to state data, homes are spending far longer on the market, and sellers are increasingly forced to make steep concessions to close deals. The region remains attractive for long-term investors, but short-term price declines seem inevitable as the market absorbs its excess supply. Meanwhile, Houston has proven to be one of the more resilient players in this correction, at least so far. The Texas Real Estate Research Center's Home Price Index shows Houston maintaining modest growth of 2.4% year-over-year in early 2025. Unlike Austin or Dallas, Houston's economy is more diversified, with steady demand from its medical, manufacturing, and energy sectors helping cushion the blow. Still, the city is not immune. Falling oil prices, hovering near $57 a barrel, threaten to ripple through local employment, which could eventually drag housing prices down in the coming quarters. San Antonio, by contrast, sits in a middle ground. Its housing market has cooled, but not collapsed, with a 2.1% year-over-year price increase masking volatility beneath the surface. The city's affordability advantage compared to Austin has kept demand somewhat alive, Yet growing inventory suggests that prices may soften further if buyer confidence doesn't return soon. Outside the major metros, smaller Texas cities are suffering the steepest declines. Pecos, Zapata, and Sweetwater are projected to see price drops ranging from 7% to nearly 10%, underscoring how fragile local economies can be when broader housing conditions weaken. These towns often lack the economic diversity of larger cities, making them more vulnerable when affordability erodes and migration slows. In short, Texas's housing market no longer moves in unison. While Houston and San Antonio tread cautiously toward stability, Austin and Dallas are grappling with steep corrections, and smaller towns face the brunt of the downturn. The regional divide highlights a new era in Texas real estate, one defined not by universal growth, but by survival of the fittest markets. The Texas housing market's correction is no longer a question of if, it's a matter of how deep and how long. Analysts and economists agree that the state is firmly in the midst of a housing reset, but predictions about the road ahead vary depending on the severity of economic conditions, especially in energy and employment sectors. What's clear from multiple data sources, including Norada Real Estate, Reventure App, and the Texas Real Estate Research Center, is that prices have only just begun to adjust after years of runaway growth. The next phase, they warn, could be the most defining moment for Texas real estate in over a decade. According to Reventure App's short-term forecast, Texas home prices are expected to decline by an average of 4% statewide over the next 12 months. This moderate downturn represents the initial phase of correction, a response to surging inventory, weak sales, and the steady erosion of affordability. The state's forecast score currently sits at 37 out of 100, signaling low momentum for price growth and strong potential for continued depreciation. A score closer to 0 reflects markets likely to decline further, and Texas's score firmly places it among those at risk. However, this -4% projection is only part of the story. Reventure's CEO, Nick Jurley, has cautioned that a deeper, longer-lasting correction could develop if key economic drivers falter. He envisions a potential 15 to 20% total drop in home values if conditions deteriorate, particularly if the oil industry experiences a recession. Oil prices hovering around $57 per barrel have already begun to strain local economies dependent on energy production. Should this trend worsen, job losses in oil-producing regions could further suppress demand, accelerating price declines across major metros like Houston and Midland. Beyond the energy factor, Texas's housing overvaluation remains a critical issue. Even after recent price softening, Jurley estimates that the market remains 10 to 12% overvalued relative to long-term fundamentals such as income and rent levels. In simple terms, housing prices are still above what local wages can sustainably support. Until that gap closes, prices will continue to drift downward. Analysts note that such overvaluation corrections rarely happen smoothly. Instead, they unfold in waves, brief stabilization followed by renewed declines as the market searches for equilibrium. The Texas Real Estate Research Center supports this cautious outlook, highlighting that inventory growth is running at nearly twice the pace seen during the 2008 financial crisis. This historical context suggests that the market's adjustment is far from over. While some cities like Houston may stabilize sooner due to economic diversity, others like Austin, Dallas, and smaller rural markets could face steeper drops through 2026. The bottom line, the Texas market is heading into a measured but meaningful correction phase, not a catastrophic crash, but a strategic rebalancing. Price declines of 4 to 10% statewide are likely in the near term, with pockets of deeper pain where supply is highest and demand weakest. It's a necessary, if uncomfortable, process, one that could ultimately restore affordability and lay the groundwork for a healthier housing cycle in the years ahead. Beneath the headlines of falling home prices and market turbulence, there lies an unexpected upside, a long overdue return to affordability. For years, Texas built its reputation on the idea that anyone could move here and buy a home. It was the promise that fueled migration, drove development, and shaped the state's identity. But as prices soared during the pandemic, that promise faded. By 2022, even lifelong Texans found themselves priced out of the cities they grew up in. The current correction, while painful for sellers and investors, represents a necessary reset, one that could ultimately restore balance to a market that had grown dangerously out of sync with reality. According to Erupts analysis, Texas home values remain 10 to 12% overvalued, even after recent price drops. That means there's still room for adjustment before homes return to historically sustainable levels relative to local wages and rent prices. But every month of gradual decline brings the market closer to that equilibrium. It's not an easy transition, especially for homeowners who bought near the peak, yet it's an essential one if Texas hopes to preserve its reputation as an affordable state. As prices cool, more local buyers will be able to re-enter the market, and the intense divide between out-of-state transplants and native Texans may begin to narrow. For first-time buyers, this period could represent the best opportunity in years. With inventory at record highs and sellers cutting prices aggressively, buyers now have leverage unseen since before the pandemic. No more bidding wars. No more waived inspections or desperate all-cash offers. Instead, a cautious, more rational market is emerging, one where buyers can take their time, negotiate terms, and make choices based on affordability rather than panic. Even with interest rates still high, lower home prices can offset some of the monthly burden, particularly if rates begin to ease later in 2025 or 2026. There's also a broader economic benefit to this adjustment. A market correction improves long-term stability by aligning prices more closely with income growth and employment levels. When housing becomes affordable again, it strengthens communities, attracts a sustainable workforce, and reduces pressure on the rental market. The current affordability reset could also help reinvigorate local economies as consumer spending shifts from inflated mortgages to other sectors. Of course, this silver lining doesn't erase the hardship of those losing equity or struggling to sell, but it reframes the correction as a recalibration rather than a collapse. Texas's rapid expansion over the past decade created distortions, from overbuilt suburbs to speculative buying, that needed to unwind. What's happening now is that unwinding in action. Ultimately, the road to affordability may be rough, but it leads to a stronger foundation. By 2026, analysts expect Texas's housing market to stabilize at a level that once again makes homeownership attainable for middle-income families. The coming months may be marked by uncertainty, but the long-term outcome, a more balanced, accessible market, is precisely what Texas needs to reclaim its legacy as the land where opportunity and ownership go hand in hand. As the Texas housing market works through its most significant correction in over a decade, economists and real estate analysts are closely dissecting the data to understand where things are headed next. From seasoned market researchers to industry insiders, the consensus is clear: Texas's housing sector isn't collapsing, but it's undergoing a critical transformation. The overheated years of pandemic-era buying have given way to a period of normalization, marked by falling prices, tighter affordability, and a return to fundamentals. Experts see this not as the end of Texas's growth story, but as a reset toward long-term sustainability. Real estate analyst Nick Gurley, CEO of Erupts, has been one of the most vocal in calling out the warning signs early. He points to the surge in active listings, now over 123,000 statewide, as a clear indicator that the boom has broken. According to Gurley, Texas's forecast score of 37 out of 100 suggests weak fundamentals and a high probability of further price declines over the next year. Texas is now the fourth most oversupplied housing market in the country, he warns, adding that buyer demand keeps dropping, and listings keep rising. His models predict a 4% statewide price decline in the short term, but he also acknowledges the potential for a 15 to 20% correction if economic headwinds, such as declining oil prices or a broader recession, materialize. Meanwhile, Marco Santarelli, founder of Norada Real Estate Investments, offers a slightly more balanced perspective. He views the current downturn as a necessary cooling period after years of unrealistic appreciation. Santarelli notes that while short-term pain is inevitable for recent buyers and sellers, the correction will help restore affordability and create healthier long-term market conditions. The Texas housing market is transitioning from superheated growth to stable growth, he says. A period of rebalancing is both expected and healthy after what we saw from 2020 to 2022. Economists at Redfin and the Texas Real Estate Research Center share similar sentiments. Redfin's housing economist Chen Zhao recently told Newsweek that Texas is among the weaker Sun Belt markets where buyers will likely find the best deals and the most selection in 2025. She argues that, despite the current turbulence, these conditions present opportunities for strategic buyers who understand that markets move in cycles. Texas will come out of this correction stronger, Zhao notes, but only after affordability fully resets. The state's economists also highlight broader implications for Texas's economy. The housing slowdown is expected to ripple into construction, retail, and local tax revenues, but not in a catastrophic way. Unlike the 2008 crash, this downturn is being driven by an oversupply of homes, not a collapse in credit. That distinction matters. Homeowners are sitting on far more equity, and lending standards remain stricter, reducing systemic risk. In sum, experts agree that Texas is experiencing a rebalancing, not a freefall. The correction may take another 12 to 24 months to complete, but most analysts believe the long-term fundamentals, population growth, job diversity, and business expansion, remain intact. For now, the state is navigating through short-term turbulence on its way to a more sustainable and affordable housing landscape. Texas now finds itself standing at a crossroads, between a housing boom that defined an era of prosperity and a correction that's reshaping its economic future. For years, the state's real estate market symbolized stability, opportunity, and endless growth. But as 2025 unfolds, that narrative is being rewritten. The combination of skyrocketing inventory, slowing migration, and strained affordability has forced Texas into a moment of reckoning. Whether this period becomes a short-term reset or a prolonged downturn depends on how the state adapts to new realities in housing, policy, and economic planning. The numbers alone tell a story of dramatic transition. From a pandemic low of just 35,000 active listings to more than 123,000 homes now on the market, the supply surge has fundamentally altered the balance between buyers and sellers. Homes once selling within days are sitting for weeks or months. In 2021, overbidding was the norm. In 2025, price cuts dominate. Yet within this turbulence lies the foundation of renewal. Texas's housing boom was fueled by speculative energy, investor confidence, and migration spikes, forces that, while powerful, created unsustainable distortions. What's happening now is not collapse, but correction, a long-needed return to fundamentals. Economically, this shift could prove transformative. For the first time in years, local buyers, those earning and working in Texas, may regain access to a housing market that had drifted far beyond their means. This rebalancing could strengthen communities, slow displacement, and rebuild affordability in cities that were pricing out their own residents. In the long term, it might even restore the state's most valuable selling point, its reputation as a place where working families can still achieve the dream of homeownership. However, the path forward is not without risk. The state's deep ties to the energy sector remain a critical factor. With oil prices hovering near $57 per barrel, a prolonged slump could trigger job losses that ripple through regional markets, especially in Houston and West Texas. Likewise, if mortgage rates remain elevated through 2026, recovery could stall as affordability improvements get offset by financing costs. The danger isn't that Texas's housing market collapses, it's that it stagnates, caught between too much supply and too little purchasing power. Still, Texas has weathered downturns before, and history suggests resilience. Its diverse economy, pro-business policies, and ongoing population inflows provide the foundation for recovery once prices fully reset. Analysts widely agree that by 2026 or 2027, stabilization is likely, setting the stage for a healthier, more sustainable housing cycle. In the end, Texas's housing story has always mirrored its broader spirit: bold, ambitious, and cyclical. The correction of 2025 is another chapter in that saga, one defined by growing pains and opportunity. The boom years built the stage, the correction will rebuild the balance. And somewhere on the horizon, after the dust settles, a more stable and affordable Texas housing market is waiting to emerge.